Good evening, everyone. So, how are you doing? I'm sure equally excited. I can already see a nostalgic feelings amongst the students here. Last session for financial management for so-called good, hard work, dedicated, persevered journey for everyone here. I'm sure everyone excited and looking forward for some positive results of the efforts being put in. So, good evening, Nipun, Geet, Janesh, Priyanka, Manoj, everyone. So I can see a lot of messages, and some people are like kind of very much feeling nostalgic about that today being the last session. And I think I have been enjoying this journey very much as you guys are. And I'm sure the results will follow soon. But I guess at the same time, we need to realize that yes, there is almost 6 to 8 weeks of hard work, and I think that 6 to 8 weeks will matter a lot, right? Remember that old famous speech of wo 70 minute. So for you guys, it's like wo 50 days, something like that. I'm sure you guys are pretty much on target with the kind of interaction we are looking at. Many of you are asking very logical questions, getting clarifications as and when required. And today being the last session of, not only financial management, but also the stream of working capital management. So what we have done till now, right? Let's kind of do a quick recap of the last two episodes, right? So I believe the first one where we discussed about the working cycle importance, the policies, we talked about the operating cycle calculation. Then we moved on to the working capital calculation, where our friend come enemy was WIP that day. I believe everyone is kind of was bothered by WIP, but I'm sure you guys are now comfortable with it. In the last class, our agenda majorly was focused on two aspects, management of cash and management of receivables. But we majorly discussed two aspects. Is in the cash aspect, we're talking about the cash budgeting, both for short term and long term. And then we moved on to management of receivables, which is yet to be continued today. But we talked about how to evaluate credit policies or credit period in terms of total approach versus incremental approach, right? So this is what we have done. And today we are resuming our session with a very important aspect within account receivable management, that is financing of receivables, right? So guys, I think let me start this, by throwing the ball in your court. Let us see what you guys have to say. Why financing of receivables can be important to an organization? Let's see your own views, guys. Why financing of receivables could be important for an organization? Let's see your views. Okay, Alok says opportunity cost. Interesting. What about others? Okay, Manoj says because receivables are not easily coming. Okay, I think Manoj, we need to probably rephrase that. I think what you intend to say is that collections are not easily happening for us, right? Maybe that is why what you want to say. I'm just kind of reading your mind. Jyoti says running the operations. Okay. Alok says time value of money. Piyush says for better allocation of cash management to enhance sales. Pranav has an interesting point. Okay, so guys, see, the point is, if I just simply ask you a question, if you need to get do some collections, would you like to prefer an earlier collection or a later collection? I think obviously everyone agrees earlier collection. Like Alok said, time value of money. Today's money is worth much more than money tomorrow, and that is why, I think it's also important that we need to understand that apart from time value of money, it's about the hassle, right? Follow up, chasing them for the collections, really a headache, right? You need a dedicated full-time employee working into that direction. So Geet says it will help to meet the liability as credit period is not equal to debtor. Yes, absolutely, Geet, very good point. So Geet is telling about in terms of the treasury management, where we are looking at aligning the timing of the receivables and the payables. So Dinesh says video is not clear. Dinesh, just check your connection as well. Pranav says to prevent ourselves from bad debts. Very good. So yeah, I think okay. Thanks, Dinesh. Nipun says liberal credit policy increases sales, but also the chances of bad debts and block funds that involve opportunity costs and vice versa. So there's a trade-off between liquidity and profitability. So Nipun has, I kind of summarized the first two sessions of working capital management. Excellent, Nipun. So I think all of you are, as usual, giving fantastic logics. Simple. Let us summarize whatever everyone has written in 2 points. One is time value of money. And second, you would like to definitely not involve into collection efforts rather than synchronizing your efforts towards your other operational efficiency areas. You don't want your invoices to be sitting into outstanding balances. As Geet said also that, you need to make your liabilities also to be paid on time. Now, there are different ways. When we say financing of receivables, there are different ways of converting your receivables into cash earlier than what they would have been otherwise, right? So let's say your credit policy we discussed in the last class that, okay, it could be 30 days, 45 days, but you don't want to wait for 45 days. Who wants to wait for 45 days? You want collection in 10 days. So now there are two options. Either we go for pledging or we go for factoring. Let's understand what is the technical difference between the two terms. Pledging is basically, as you generally pledge any fixed asset or any asset when you go for any financial assistance from bank or in the form of a loan, right? So what you are doing here is you are approaching a financial institution, let's say a bank, you're pledging your receivables and you are getting a loan. Now, how my balance sheet will look like once I do that? If I look at my balance sheet, it's like in the current assets, you would continue to have your accounts receivables or sundry debtors. That would continue to be there. And then in your liability section, whether current or non-current, depending on the tenure, there will be also a debt or a loan. Not only that, generally this kind of an arrangement will have two kind of features associated with it. One, that financial institutions would do a little bit more of a deep dive into the quality of the receivables you are pledging with respect to the kind of financing they can provide. Now that financing could range between 50% to 90%, but you can imagine any bank giving, let's say you have an account receivables of 1 lakh and bank gives you 90,000 loan against that. It could be only and only possible when there is all your customers are having a very, very positive credit rating, reputation, and they have done their due diligence. But generally, you will get definitely not 100%, but realistically, it could be anywhere around 60 to 70% financing. So whatever is your receivables, you will get 60-70% finance. Not only that, in these kind of arrangements, the kind of interest the financial institutions will charge would be significantly higher. So that's why we say it's like a high cost of financing. And also, Dinesh, I will talk about that. Dinesh is asking a question. Is there any difference between discounting bills receivable and pledging receivables? Okay. So again, what is happening, Dinesh, in pledging receivables is that you are just kind of keeping that as a collateral, right? In the pledging, you're keeping that as a collateral. You are taking a financial assistance, and you will be paying that loan off as and when your customers will be paying you, right? You're just getting a funding in advance. That's it. But that is impacting your ratios, right? That is impacting your leverage ratio, debt to equity ratio in the case of pledging. And when you talk about discounting of bill receivables, there, generally you remain contingently liable. You already pay the fees for getting the funds, and it is then the bank's responsibility to get the same collected. And depending on the arrangement of whether it is recourse or non-recourse, you could be contingently liable also. So, discounting is altogether different ballgame. Here, what we are talking about is your account receivables, how that can be financed. This is an arrangement of pledging here. On the other hand, there is another arrangement called factoring. Now, how factoring is different from pledging is? And whatever features I just told you with respect to the pledging, factoring would also, it will definitely be on a different, you know, platform, different level altogether in terms of the contingency involved or any kind of a percentage involved in terms of the financing. But let's understand what is factoring. Now, in factoring, you are basically selling your receivables. There are companies, there are agencies who actually have this primary task, which help companies, you know, help the companies in financing. They buy your receivables, they give you the funding, and then they will ensure the collections. Now, even in that, I will talk about, you know, there could be a liability which can fall back upon you. I will talk about that. But first, let's understand that how factoring is different from, you know, pledging. Now, since it is outright sale of receivables to a factor, there is no loan coming up. So if I look at my balance sheet here, in the current asset side, there was AR, which gets sold out. Instead, you will have a cash or bank balance. And at max, you may have some amount receivable from factor, which I will tell you what exactly that is. What amount is receivable from factor is, you know, these financial agencies, these factoring agencies, they keep some kind of a reserve. We also call it a factoring reserve. And this could be on account of, let's say, some of the sales may not be final, right? There could be some price adjustments. Then, you know, it could be any kind of a contingently liable issue. So whatever. So depending on the arrangement between your factor, you may owe, or you may get, you know, have a receivable amount from factor to a very, very smaller extent. Now, if you look at from a liability perspective, is this a loan? Is there anything coming in liability? No. Your liability, your balance sheet remains clean. No impact on debt equity ratio, because more and more the debt in your balance sheet, the further financing becomes challenging for any company. Now, in this case, you're selling the receivables to factor. So now you are getting the funds. Now, the factor will charge for their services in the form of a commission, B, because like some of you talked about time value of money. Many, you know, when we talk about time value of money, that means you are getting funds 30 days, 60 days prior. So they will charge interest on that and can withhold some amount, like I said, factoring reserve for any sales which may not be final. This is the third point which is mentioned here in your screens. You know, you're talking about commission, interest, and also some kind of a factoring reserve. Adjustment as in, like, there could be credit note, debit to note, there could be some sale return, and so on. Now, within factoring, as I said, it could be a possibility of contingently liable. The terms we actually use is that factoring arrangements can be with recourse or even without recourse. Now, with recourse means the factor can fall back upon you that, okay, hey, you know, these customers are not paying us, you know, take these customers back, these are your responsibility. So this is an arrangement, right? So it's if it's with recourse, they have a recourse. The factoring has a recourse. The factoring agent can come back to you that, no, this is not done. They are not paying us. These guys are really, really tough. Whereas another arrangement where they cannot come back to you, they bear the entire risk. You sell to them, that's it. That's non-recourse, guys. When we talk about non-recourse, the factoring doesn't have any option. The factor bears the entire risk of loss. If customers don't pay them, it's their loss. Okay, let me ask a very, very logical question. What do you think? The factors will charge higher commission in recourse arrangements or non-recourse arrangements? Let's see your responses. Where would a factor charge a higher interest comparatively, whether it is in a recourse arrangement or a non-recourse arrangement, based on our understanding? Okay, I think almost 7 to 8 answers already. Geet says, of course, non-recourse. Nipun says non-recourse. Abdul, you have a slightly different answer. I think almost like 90% students are giving me non-recourse. Guys, logically, if you're taking more risk, remember that factor, right? More risk, more return. So if they're taking more risk, they would need more return. So they will charge you higher commission. Right? So make sure we understand this. And if they do not carry that much risk, they may charge you less. Now, what do you mean by recourse? Can factor give those returns back, those receivables back to you? That, okay, you gave us almost 30 receivables. These 3 receivables are not good. Take them back, give us money back. No, it doesn't happen like that. Generally, if there is an arrangement which is a recourse arrangement, where you have sold the receivables on a recourse arrangement, that is, the factors can fall back upon you, then what happens generally is that they can come back to you with those receivables and they can ask you to replace those receivables. So let's say they are the 3 customers who are kind of not paying even to the factors. The factors will request you that, okay, you need to replace these receivables with another receivables, because yours is a running operation, right? You may have more receivables on a regular basis. So those receivables will be replaced. So this is again a difference in factoring and pledging. But I'm pretty sure that you guys are clear on this concept that yes, from a health of the financial statements, you may actually think that, okay, factoring is much better than pledging over here in terms of the financing. Now, we also need to understand that, okay, there are different agencies, there are different factoring agencies providing these services of, giving us the collections of the receivables. Now, how do we decide, okay, should we accept the proposal or not? Till now, whatever we discussed, right, in the credit policy evaluation, we talked about, okay, which policy gives us the maximum benefit, we select that. Do you agree with me that even for evaluating the proposal from factoring or financing agencies, the decision factor would remain same, the one which would be giving the maximum benefit? Or let's say that when you are taking money from factoring, it's costing you less in terms of whether you would have other way around taken a loan. Make sense to everyone? So if there are multiple agencies approaching you, you can go ahead with the one which will be giving you the least cost. And if we are talking about evaluating a particular factoring agency's proposal, you could take the cost benefit analysis. Whether what is the cost and what is the benefit they are providing you. Geet, Manoj, absolutely. Okay. Manoj says, which type of industries go for factoring? I think, Manoj, this is not industry specific, right? It's about more from a need-based scenario also. When we talk about working capital management, it's like, okay, now my general answer would be any company would generally have a higher amount of receivables. Would go for this. Okay, the question coming in from Pranav, if rate on factoring and pledge is same, then which would we choose? Okay, Pranav, again, I never said that companies never pledge. There could be some companies would be doing pledging, but I just said that, okay, in terms of pledging, since the account receivables are not removed from a balance sheet, there also enters a loan. So in that case, what is happening is that your debt equity ratio is also impacted now, right? So it's not key. We are saying that, okay, say no to pledging. We are not even talking about that. I'm just saying that, okay, factoring is better than pledging, but it would be definitely the entity's call. Let's say they are not at all debt oriented. They are not at all taken any debt. They may go for pledging also. What if the pledging arrangement or the treasury team negotiations with the banking institution is much better than the financial institutions are offering factoring? Then what? Go for pledging then. You remember 50 to 90% we talk about, right? So it could be a scenario that in a remote case scenario where you are actually going for pledging as well. Anyways, so let's talk about this particular statement which says, how do we evaluate a factoring proposal? You all said correctly that we are looking at cost benefit analysis, right? So first, let's say what are the annual savings on taking the factoring services? I think the staff who would be chasing the customers in terms of from administrative perspective could be re-channelized into some other work. So that cost of administering, the time, the efforts, that would be saved. I think someone said factoring or this financing or receivables can help you to reduce the bad debts. So that is one saving. And the most importantly, what about time value of money? You guys said, right? So interest saved due to reduction in average collection period. Right? So let's say your credit period was 45 days, but now you're getting in 15 days or 10 days. Right? So that interest saved. Whatever is your now mind you, don't multiply. Okay, let me ask this question. When we are calculating the interest savings here, interest saving should be calculated on what, guys? Should it be calculated on sales? Let's hear responses. Because debtors owe you money, right? Should you be calculating the interest savings on the collections from debtors? Let's see who answers this question. Geet is always on the top. She says cash cost. What about others? Piyush says cash discount. Piyush, I think you might wanted to say cash cost, right? We are not calculating interest on cash discount, of course. What about others? Okay, some people said on collection. Guys, why we would do on collections, right? There's a profit element also, na? So when we're looking at interest saved due to reduction, we're saying that, okay, whatever the time we are saving for recovering our costs. So cost of annual credit sales is what we are using here. Okay. Anyone else? I'm just looking at some responses here. Okay, Pranav says, yes, sir, the amount we owe to debtors. So guys, everyone okay here? Said we will be using our cost of annual credit sales. Yeah, great. Now, that is my total savings, guys. Savings comprising of cost of administration saved. We are looking at bad debts avoided. And third, we are looking at interest reduction. Now, what about the cost? We talk about broadly brokerage, commission, and interest, right? So what is the factoring commission here? Would be based on the, now this could be based on the sales, right? They would be talking about the commission on the sales, whatever it is. Now interest charged by the factor on advance. Now this is important, guys. This is a very important point. I want everyone to be focusing on this right now. Why I'm saying this is important? Because, guys, as I said, the factoring agency will withhold some money, right? I hope everyone understood that point. If you understood, can you tell me why the factoring agency will hold some money? I explained you on the last slide. Why would they hold some reserve? Let's see the responses. See, what I'm trying to explain you is on what amount the interest will be computed. Alok says risk. So guys, they will be the whole money for some kind of a sales. Like, there could be a scenario where that you would have recorded sales, but those sales could be adjusted, right? There could be sales return, there could be credit notes, debit notes. So they hold some kind of a contingency, Pranav says. So Pranav, that contingency will of course depend on Geet, you also. When we talk about contingency, that will depending on anyways recourse and non-recourse element. That is taken care of. But what I'm trying to say that even logically some sales may not be final, right? So on what amount should the interest be calculated? Should this be calculated on the entire amount of receivables sold, or the amount the factoring agency is giving you? My answer would be the amount the factoring agency is giving you, because you see that annual credit sales minus the commission, because they are deducting the commission also, and they are retaining some amount. Now this will be in your balance sheet, right? This will be still in your balance sheet. So AR will be, so let's say if the AR is 100 and you have sold this AR, probably your AR will be like, receivable from factor. AR will be replaced by receivable from factor, let's say 10. So out of 100, only 10 is, let's say the commission is 5. So that means in this case, the amount will be 100 minus 5 minus 10. So 85 we will be using for calculating the interest. Sharon, absolutely correct. Okay, guys, everyone okay now? That whatever the commission they are charging and the factoring reserve they are keeping, so what exactly the amount they are paying you will be multiplied by the rate of interest for, of course, the number of days for which they are giving you the payment earlier. Everyone okay till now? Geet, Abdul, Pranav, Manoj, Aarti, Priyanka, everyone doing good? Okay, great. Now, guys, till this point, you can compare your cost and benefit, right? A was your savings, B is your cost. So if your savings is more than a cost, go ahead. But we are looking at one more aspect. We are looking at one more aspect, that what is the net effective cost of the factoring to the firm. So there could be a scenario that it's costing you something versus there was some benefit. So there could be net cost, let's say. So what is the net annual cost? You can calculate that in terms of percentage. Net annual cost, whatever the advances you are getting in terms of percentage. Now that is something which you can compare with our loan percentage. If this cost is less than the borrowing cost, you could definitely go with the factor proposal. If your cost of factoring is less than the cost of borrowing, you should definitely go with the proposal. I hope this makes sense to everyone. So I think let's take an example here, an illustration, which will make things further clear here. And this always has been the case. So Heaven's company has credit sales of 240 lakhs. Its average collection period is 30 days. Financial controller estimates bad debts losses are around 1.5% of credit sales. Firm spends 1,40,000 annually on debtors administration. Almost like more than 11,000 per month, right? So this cost comprises of telephones, fax, bills, along with salary of the staff. These are avoidable costs, very interesting. A factoring firm has offered to buy the firm's receivables. The factor will charge 1% commission and will pay in advance against receivables on interest of 10% after withholding 10% reserve. So 1% commission, 10% interest. The balance you will be getting, on which interest will be calculated. The question is, suggests that should you be accepting the proposal, guys? Now, my point is, in this case, you look logically, how much is the cost we are incurring, guys? How much is the cost we are incurring? Can anyone tell me? From a cost perspective? Presently, I mean to say. So what is my present cost? I think 1,40,000, I guess. That is one part which is given to us. Administration cost, plus there is a bad debt also. So 240 lakhs into 1.5%. How much are we getting, guys? 1.5% of 240 lakhs. Someone says 3,60,000. Am I correct? So total cost is how much? 5 lakhs. I'm just looking at the responses simultaneously. Okay, great. So everyone is okay with 5 lakhs total cost. Now, what is the cost when the factors are involved, right? Because this is the save, this will be your saving, right? If you go for factor, this will be the savings. 5 lakhs you will be able to save. Let's say what are the costs the factoring has to charge. Interesting, 1% is the commission, right? So what is the commission here? I think commission will be 20,000 into 12, 2,40,000 if I'm not wrong. So commission is 2,40,000. Okay. And then what are we looking at? They are also withholding 10%, right? We are looking at a commission of 2,40,000, and they're also holding 10%, which is out of 240 lakhs, I think 24 lakhs, if I'm not wrong. So what is the interest, guys, on the sale? Okay, let us look at this calculation first. This now, if you see the concept here, we are looking at annual numbers. But do you agree that this will be kind of a recurring nature throughout the year? Yes or no? So what I'm looking at is I have a 2,40,000 sales on which 1% commission is charged. That is out of 240 lakhs, 2,40,000 is the commission, and 10% is the reserve, which is 24 lakhs. And on an annual basis, there will be a 10%, or how much is the interest, guys? After withholding that, right? So if you look at from a monthly perspective, every month the interest comes to 1,78,000, guys. How did I calculate? We are looking at 240 lakhs minus 1% is 2.4 lakhs minus 24 lakhs into 10% into 1/12. Every month this will be happening, guys. I think everyone calculated that 1,78,000. So I'm looking at 2,40,000 as my commission, and interest is being charged as 1,78,000, which is more of a 4,18,000. So I am incurring 4,18,000, but I'm getting saving kind of a 5 lakhs. I think it looks to be a good idea here. But let me show you alternative calculations here. On the left hand side, if you see my average monthly receivables, if my yearly sales is 240 lakhs, my average is monthly receivables is 20 lakhs, right? So 20 lakhs. Now, the factors commission is 20,000. Factors retention is 2 lakhs. The amount available for advance is 17 lakh 80,000, for which your interest will be 10%, that is 14,833. Now, this is again, don't worry, the annual interest charges happen to be a 1,78,000 only. Don't get confused. Reason is that this is the interest you will be charging every month, and 240 lakhs was the annual charges. So what we are doing here is, for the interest calculation, we are looking at the monthly receivables. Guys, is it okay to everyone? For interest charges, we are trying to evaluate this on a monthly basis. So my amount available for advance is 20 lakhs minus the commission and interest. So 17 lakh 80,000, 10% is for the year number. We are getting a 14,833 for the entire month. And then we multiply that by 12, we'll get the same answer, 1,78,000. Right? So that means if we compare our benefit versus cost, what was my benefit, guys? My present cost was 5 lakhs. Will that be savings? Yes or no? Will that be savings? 5 lakh savings. And what is my annual factoring cost to the factoring agency, Heavens Company? Commission 2 lakh 40, interest 1 lakh 78, 418. So I'm basically getting a net benefit of 82,000 here. So I think this is a proposal worth thinking, but I want anyone having any doubts, let me know, please. Any doubts on this illustration? Any doubts, guys? Any questions so far? All good. Okay, Sapna, thanks. Piyush, Dinesh, Pranay, what about you guys? Great. Okay, Pranav, because what we did was, I think Sharon also had that question. Pranav, what we did was, if you look at the monthly numbers on the working, we do because these collections will be every month, right? This sale of receivables will be throughout the year. You're not doing at the end of the year, right? It's every month. So what we did was we calculated the monthly receivables. Now 10% is the rate per annum given in the question. So monthly interest is 14,833. But you multiply by 12, you're getting it 1,78,000. Why I did 1 by 12? Because this was a monthly exercise. Monthly exercise. You cannot apply it on an annual number. I hope this is clear now. So 1,78,000 is my annual interest. That was just for that 1 by 12, which I did, is just to make sure that it is converted into a monthly interest rate. That's it. That was just to convert 10% to a monthly. But monthly interest for 12 months will be into 12, right? That is why 1,78,000 is coming both the ways. I hope this is clear now. Okay. Now, guys, let's talk about a very interesting concept. After this, there's something called forfaiting. I don't know how many of you have heard about this term earlier. It's like about relinquishing a right. Now, what is happening here is like in terms of encouraging the international trade, where think about that in a normal trade, when you are talking about credit period, we talk about due diligence, understanding of the customers. But what about the international trade? What about the international trade? If you think of exporting to an importer in another country, will it be that easy to do a due diligence, to do a credit check? How would you trust? How can an exporter, sell to someone whom you don't know? Or for vice versa, how would an importer makes an import without immediate payments? Any thoughts, guys? So this role, okay, so just give me a second. Piyush is asking a question, does the factor will return retention money? Yes. So again, Piyush, it's a vicious circle, right? The sales will happen all the time. So you probably will continue to keep that reserve in nutshell, that the reserve would be just once, right? Maybe if you have done the reserve from April, you may not be doing the same reserve in the month of May. Piyush, makes sense? A very good question though. It's just said more on a revolving in nature. Okay. So Partho has given me an answer, even Manoj, even Geet, that we're talking about more from a perspective of letter of credit from the bank. So exactly. So guys, what we're looking at here is that the idea is that the exporter will relinquish the right. Forfeiting means relinquish. What do you mean by relinquishing the right? That exporter will relinquish the right to receive the payment from importer. Instead, it will be done by the bank. So what happens is the overseas buyer, which is also an importer, they will approach to their bank who provides the services. That hey, we need to import so and so goods. This is our exporter. We want a kind of a assurance that okay, that you will be paying for the same. So what do you think? The banker will give the letter of credit straight away. Importer will draw a letter of credit, but of course the bank will ask details, right? The order, the bill of lading, the documents confirming the receipt of goods or whatever, right? You will be definitely wanting to have the entire contract between the importer and exporter, and you will also have your, probably the goods will be as a part of the collateral arrangement. But this, having said that, this is more of a arrangement which facilitates the trade, right? Exporter importer don't know each other, but there is a common scenario, that is the importer's bank associating with the or dealing with the exporter's bank, right? Importer and exporter banks come into the picture. Manoj, this is a revolving arrangement, na? So factor will be paying you the whatever arrangement is, could be monthly. You definitely don't want to wait for yearly, na? Then why you're factoring it? Yeah. So whatever the date of receivables sales you decide, so that is based on the arrangement. Okay. So coming back, guys. So are you guys understanding this scenario that importer is kind of drawing the letter of credit from the bank? Now the exporter will be selling the goods, and the exporter will be approaching the bank, and the bank will pay the exporter. So basically what happening is importer banks paying to the exporter bank, and the exporter getting the money from the exporter's bank. So basically you're not getting the money directly from the importer because you relinquish that right. Guys, is it clear? I think it is very, very common sense also that, you don't get into those nitty-gritties of, importer being defraud, or in terms of, delaying the payments, and that could hamper the international trade and the trust issues. So these, of course, the banking agencies will have their own charges for these services. But yes, having said that, nevertheless, that the export or the international trade gets continued and even expanded. So that's about forfeiting, guys. Okay. Now, let's also talk about some latest developments, guys, in terms of monitoring. I think some of these we already talked earlier. Just a quick recap. We're looking at a re-engineering receivable management. What is this? We talked about locked boxes earlier. We talked about the NEFT, online transfer. I think there is a very interesting aspect called direct debit. Can anyone tell me what is a direct debit, by the way? And most of you might be doing it already. What is a direct debit, guys? Many of you would be doing it already. I'm telling you that. Look at Geet. Geet is kind of giving me an answer with the example. Geet says automatic deduction on Netflix subscription. Geet, I am lucky on that regards. I had that issue earlier with Netflix, and somehow my credit card was used on a default, kind of a different transaction, and that need to be blocked. So now every month I get an email. My payment doesn't get through unless and until I receive an OTP. So I'm lucky on that regard. But yeah, it's a good example. But I'm sure. Okay, let me see other answers. Jyoti says electronic fund transfer. No. It's not electronic fund transfer direct. Okay. Technically, it is like the funds are transferred electronically, but I'm asking what exactly is direct debit. Withdrawing cash, Piyush, no. Credit card transactions, okay. Okay, Manoj says Nirav Modi scam was about. Okay, I think Manoj, that was much beyond that. So let's not go into that right now. Okay, so guys, yes, very much. Pranev, thanks a lot. So Pranev, Geet, your answers are very much close to what I'm asking. Geet, perfect answer. Pranav, you say bank deduct the amount and transfer as per your instructions, guys. There is something called standing instructions now. You guys might be doing that for utility bills or postpaid mobiles or any of your household electricity, or your parents might be doing it. Your elder siblings might be doing it. Basically, that where you add the biller, and wherever the bill comes from that biller directly to the bank, and the bank deducts, right? Similarly, it happens for a lot of companies. Like, for example, when I was working for Whirlpool, there used to be the accounts payable team who used to set direct debits for a lot of vendors. And that kind of now that was majorly from a payables perspective, but the same intention was to improve the relationships with the vendors here. So absolutely, Sapna, Jyoti is like more of a relationship management, and you just kind of give the standing instructions. Yeah, Sapna, even LIC premiums and all those things can also be kind of used for setting up the standard or standing instructions. Even I had done that in the past. Anyways, the second one is use of latest technology. Now, okay, I can give you my personal example. When I was working in corporate, so what used to happen is, so most of the companies are using ERP systems. Let's say they're using SAP. Now, whenever a new customer is being set up, initially you don't know a little bit of a background other than the due diligence you did, right? Would you like to do unlimited transactions with that customer, or probably set up some initial credit limit? So let's say there is a new customer and you have set up a credit limit of 2 lakhs. Now that you have made 3 or 4 transactions, which are like total amount due is 1,90,000. Now next invoice comes, there is next sale transaction, and the next invoice is of 30,000. Now what will happen is that when you are, accounting for that invoice within that ERP system, it will not allow you. It will block. It will not allow you to, raise even a goods dispatch note probably, or raise the invoice against that customer. That then you would definitely request customer that so and so many invoices are pending against your previous dues. Kindly clear those invoices for further transactions to take place. Or other way around is, if you have had decent experience with that customer, you can expand the credit limit later on. What I'm trying to explain you is the concept called credit limiting. There could be a blockage of transactions beyond a credit limit. Right? So this is important. Now, this can be increased. Credit limit can be increased. There is no second doubt on that. But that is once you have more and more better experiences. Please listen to me carefully. I'm not talking about bitter experiences. I'm saying better experiences with the customer. Yeah. Use of financial tools and techniques. Now, I think this is something we discussed, right? Evaluating the customers with using the due diligence, credit rating agencies, do your internal analysis in terms of the aging analysis. So that's what is happening for many companies these days. Efficiency in internal business practices. Remember our float management, getting into the more of a continuous monitoring and going on to for online transfer facilities these days. Something called robust legal practices. Of course, compliances, laws. Every company has a compliance team these days. So these are some interesting tools which have been used either solely or in combination with many companies. So let's look at an example here. Here, what is happening here is Abhipra Limited has a current sales of 18 lakhs per year. So Piyush, I am into I think I gave my introduction initially. So I'm a chartered accountant and a CPA from US. So I've been training for almost last 15 years. Like first 10 years I was with corporates and used to give trainings on weekends, but now I am associated with multiple colleges, education institutes providing international courses with ICI for almost last 3-4 years. So I'm into more of a visiting professor and a freelance trainer right now, but used to be in corporates for almost a decade. Anyways, so Abhipra Limited has current sales of 18 lakhs per year. Cost of sales is 75%. Bad debts are 1%. Cost of sales comprises 80% variable cost and 20% fixed cost, while company's required rate of return is 14%. The company currently allows customers 30 days credit, but is considering the increasing this to 60 days. Now, it has been estimated that this change will increase sales by 15%, while bad debt will increase from 1 to 4. And it is not expected that the policy change will result in an increase in the fixed cost and creditors and stock will be unchanged. So, should the company introduce the proposed policy, remember this we discussed in the last class. What about the evaluation of multiple policies, right? Okay, so let's see what are your thoughts. How should we approach on this question? I'm sure the facts which are given kind of help us to give a little bit of a straightforward information, which you can see a new level of sales, which is like how much? 15% increase. This is given to us. That is one new level of sales is 20,70,000 here. Variable costs are how much, guys? Cost comprises of 80% variable cost and 20% fixed cost. So whereas cost of sales is 75%, I'm sure you guys need to be careful on this. So 75% is a cost, and out of 75%, 80% is variable. Is everyone okay with this? Out of 75% cost, 80% is variable. That means 60% of the selling price. 60% of selling price is the variable cost. And hence, the contribution from sales becomes 40% of the sales. Now, they've also given an information that things are not going to change, right? There is no increase in the fixed cost. So it is not expected that the fixed cost will change or creditors or stock. So let us see what is my current level of fixed cost, guys. Current level of fixed cost, again, 20% of 75%, that is 15% of sales. So 15% of 18 lakhs is, can anyone tell me? What is the fixed cost over there? Anyways, it is not going to change. I'm just asking casually. I think 2,70,000 it seems. Anyways, see, the point is, should the company introduce the new proposed policy? That is my point. Now, and what is my current period, guys? Correction period? 30 days. We are planning to increase it to 60 days. And that is why it is happening. But the most important factor is that my bad debts are also kind of increasing from 1% to 4%. And that is generally the consequence here. So let's discuss this. Guys, what is the additional investment? Can anyone tell me? What will be the investment in the debtors? Additional investments. For that, you would need to know what is the current investment in debtors. Let's calculate that. What is my cash cost? Current investment in debtors. 30 days is the policy, right? So 18 lakhs into 75%, including fixed and variable both, into 30 by 360. So what's that? I'm getting 1,12,500. Can anyone double check this, please? That is my current investment in debtors. $1,12,500. Sharon says, how come it is 1.15? Sharon, because it is given to us now that sale will increase by 15%. 15%, 100 plus. So if 1 plus 15% is 1.15, simple. Okay, then what is my proposed investment, guys? Because this will help us to calculate what is the additional investment, and that will be opportunity cost, guys. So 20,70,000 into 60% is one part. 2,70,000 is the fixed cost. That is not going to change. Into 60 by 360. What's the amount? I've just segregated variable and fixed for the proposed investment because you know that the fixed cost is not changing, but the variable cost will change. I'm meaning 2,52,000, guys. So this is my new investment. Abdul, can you check? Geet, I think there is some problem. Your calculations are not matching. I think way different from what I did. Make sure that for the proposed investment, don't multiply by 75%. Fixed cost is not going to increase. Fixed cost is not going to increase, guys. Fixed cost remains 270. You guys calculated with me, right? 270 is the fixed cost. You guys only told me. 18 lakhs was the present sales into 15%. That was the fixed cost, 2,70,000. So that is fixed. So that means what is my additional investment, guys? 2,52,000 minus 112,500. 139,500, guys. So what's the opportunity cost for 139,500? Are we talking about any kind of interest? Required rate of return is 14%, guys. That's given to us. Into 14%. Now here you can do is 1 by 12 and then multiply it by 12 because we are looking at annual level. What is the opportunity cost? So 19,530. 19,530 is my opportunity cost. Okay. One more thing is increase in bad debts. Who will tell me the increase in bad debts? Present bad debts is 1%, right? So 80 lakhs, 1% is 1,80,000. And then sales is 20,70,000 into 4%. So minus 18 lakhs, sorry, 18 lakhs, 1% is not 1,80,000, it's like 8. How much is that, guys? 18,000 if I'm not wrong, right? So it'll be 18,000, not 1,80,000. So 20,70,000 into 4% is 82,000 minus 18,000. So we're getting an increase in bad debts is minus 18,000, which is the current level. This is 64,800 if I'm not wrong. So guys, these two are my total cost. 19,530 plus 64,800 is my total cost. 84,330 is my total cost. But how do I compare this? What is my benefit here? Can anyone tell me what is the benefit? I think my benefit is additional sales, right? So benefit is additional sales. But mind you, in the additional sales, there is a variable cost also. So what is my additional contribution here? Sales have increased by 2,70,000. Contribution is 40%, is 1,08,000. So I have my additional contribution as 1,08,000. On the other hand, I have a cost which is 19,530 and 64,800, which looks like to be 84,000 something. Which looks to be a good plan, guys. My contribution is increasing by 1,08,000. My costs are increasing by 84,000 something. I am kind of thinking that okay, this looks to be a good idea. This policy seems to be beneficial for the company, guys. What do you think? Any thoughts so far? What are your inputs, guys? Should we go ahead with the policy? Should we accept it? Okay. Any questions, guys? Okay. Someone said 23,670 is the profit. Good. So I think, anyways, you can probably now cross check your answers and calculations. This is anyways there. And guys, as always, what I will do is after today's lecture, maybe in a couple of days' time, I uploaded the investment business file a little late, but I will try that maybe in a couple of days. I will upload another file for working capital management, which will have the solutions also for the questions. There are certain questions we'll be practicing in class. Maybe one or two questions can be given as a homework for you guys. But we'll have devised a file with solutions also later. Any questions so far? 23,670 is good, right? Okay. Sharon says contribution will be 60%. Why? Why 60%? My variable cost is 60%. So contribution is 100 minus 60, 40%. Sales minus contribution. Sales minus variable cost is the contribution, right? Sharon, please check. Okay. Geet has a very, very interesting point. Geet says with increase in sales, collection and administrative expenses, this is fixed cost as well. Geet, although not specifically given to us, but maybe we can just think that, okay, that is part of the fixed cost. We cannot take assumptions. And I think what I get your point, because what you're thinking is probably you are looking from a perspective of what we studied in factoring, right? So we are not mixing factoring here where you compare that administrative cost with the cost charged by the factor. I agree with your point, but we don't need to go there. I think rather than taking that assumption, okay, we are not given those aspects with respect to the administrative cost, I would say that it is better that to assume whatever fixed cost is given is everything. Geet, I hope that makes sense. Okay, great. Okay, Sharon, somehow, Sharon, your case, when you're asking questions now, I think there are a lot of rows which are coming in blank. So Sharon, please check. I don't know why it is happening. I can see like a lot of rows which are like coming as a blank. Maybe just double check at your end. When you're posting queries in the query panel, there are a lot of blank entries. Okay, great. Sharon, variable is 80% of the cost of sales. Sharon, variable is 80% of the cost of sales. Cost of sales is 75%. Huh? So if out of 100 rupees, my cost of sales is 75, and the Variable cost is 80% of 75. How much is this? Please calculate. That will be 60, na? 80% into 75. So if my sale is 100, variable cost is 60 then. Okay. So let's, so Sharon, please check your calculations. Okay. Okay. Now let's talk about a very, very interesting aspect, guys, in terms of management of payables also. Now this is a very, very self-explanatory thing, but let's talk about it. We discussed earlier that, you know, on one hand, we want to accelerate the collections, and on the other hand, we are talking about deferring the payments, right? So accelerate the collections, defer the payments. Now, in terms of the vendors, of course, the relationship management, now they would do a due diligence for us, our goodwill, you know, our reputation. So now what happens is, generally, there are two types of discount, right? Trade discount, cash discount. Cash discount, trade discount is something which is related to the quantity, which is adjusted in the invoice. Cash discount is something which could be provided by them for as an incentive for early payment of the invoice. Now, in the agreements, there is something called credit terms, payment terms, which we discussed earlier, like 2/10 net 30, which means the credit period given by the vendor is 30 days. But they're saying that, okay, if you pay us within 10 days, we give you 2% discount. Now, think logically, how should I decide? Should I pay early or should I pay later? If I have to pay early, I have to arrange those funds 20 days earlier, right? Am I correct? Guys, is everyone with me? Everyone on the same page that if my credit period is 2/10 or payment term is 2/10 net 30, if I'm availing the discount, I'm paying on the 10th day. And if I'm not availing the discount, I'm paying on the probably 29th or 30th day. Everyone okay here? No one would do this, like you don't want to avail the discount and pay on the 15th day. No one would do that, right? You want to use the entire credit period. Am I correct? Or if you want to take the discount, you're not going to pay on the 3rd day, right? No one is giving you extra shabashi for this. Now that means Geet, absolutely wonderful. Geet says 20 days opportunity cost needs to be compared with the discount. Yeah, absolutely. So we are moving that there. So if instead of 30th I have to pay on 10th, I'm arranging funds 20 days earlier. I could have invested that money somewhere else, right? So I would see that what is the interest rate in the market, and I would compare that with the cost of foregoing the discount. What if I'm not taking the discount? See, 2% discount, can you imagine? It is not per month, per annum, it is flat 2%. Just for paying the bill in 10 days, you're getting 2% discount. So that 2% is for 10 days here. But don't you think if I have to compare with the rate of return available in the market, I need to calculate a comparable number for the discount? Do you agree with me? 2% is for 10 days, but I need to annualize it, right? So you need to know this formula called annual cost of foregoing the discount, guys. It's an annualized number for discount, basically. If you see 360 upon credit period minus discount period into discount upon 100 minus discount. So let's see in this case what's happening. 360, my credit period is 30, discount period is 10, discount here is 2%, and 100 minus 2. Can anyone give me the number for this? See, anyways, anyone can tell that, you know, even from a naked eye, that okay, 2% discount we are looking at for kind of 20 days early payment. So out of 360 days, like 18, 360 by 20 is 18, right? So 18 into 36. 36 should be roughly the answer. But let's see what is the accurate answer. 360 divided by 20 into 2 divided by 98. So I'm getting 36.73%, guys. Even from a naked eye, you could say that, okay, it's 36% roughly. Because 2% was for 20 days, right? So for 360 days, it's like multiplied by 18. But I think this is the formula you need to remember. 360 upon credit period minus discount period, discount upon 100 minus discount. See, as far as my experience goes, I've been teaching about, at ICI, I'm, giving a lot of trainings on CPA for 15 years, CMA, ACCA, different courses. I'm talking about universities in US, UK. I think nowhere I've seen that the interest on the investments or the deposits could be as high as 36, 37%. Even in India, I guess there was definitely a huge fall in the interest rates in the last couple of years, but now it's like kind of getting back when you are thinking of fixed deposits and stuff. They're like 7 to 8% as an average. Now it's still decent, but of course not that decent to beat the inflation. But still, do you agree that if you're looking at like 8% return in the market versus 36% is the cost of foregoing the discount, you would definitely avail the discount? Do you agree? Will you agree with me on this? 36% is the cost of foregoing discount. Will you forego that for 8% interest? I don't think so. Save that money. Any thoughts? Great. I think everyone is kind of agreeing with me. Great. Okay. Now, the next aspect is inventory management. But let's do one thing. I would take about inventory management also, but I would like to test you guys on some questions first. So let's have some brain teaser here in terms of your MCQ. So question 1 and 2. And I want you guys to give me an answer with the question number. Okay, I'm getting some answers here. Question number 1 is, everyone is kind of unanimously giving an answer, is option number B here. Everyone says, like, when a firm advises its customer to mail their payments to designated post office collection center, this is what I told you day before yesterday, right? That is an arrangement with the banks, and that's where we're looking at a logbox system. So I agree with everyone. It's B, guys. Very good. Geet, I was like thinking about your query, but thanks for clarifying. I would have anyways come back to you, but thanks for clarifying. Okay. Coming to question number 2 also, I think this is a very, very simple piece of cake. Gross working capital. I think everyone got it easily. The word is gross. That is, we are looking at a investment in current assets. Good, guys. Very good. Now, one part is also kind of important, and I guess many of you would have done this in your earlier costing aspects, if I'm not wrong. Have you talked about this EOQ, inventory management things? So I understand that you guys are all knowing this, that what we're looking at here is that in inventory management, our idea is that, remember my example when we started on Sunday of working capital, I took an example of a Domino's and a pharmacy, right? Where we look at one having a lot of stock, other cannot afford to have a lot of stock. But generally, the idea is that between profitability and liquidity, you do not want to have a higher amount of inventory and block the liquidity to have high profitability, because there could be a scenario of perishability, and there could be storage cost, insurance. The benefit is profitability, no stockouts. Whereas low level of inventory, you will have liquidity, but the problem is that you will save on the warehousing cost. But the problem is that what about you have to order more and more, order again and again. There could be stockout cost, loss of repetition. And one of the ways to manage that inventory level is your favorite one, right? Economic order quantity, EOQ. I think like we discussed this in the receivables also, right? I hope you remember that. The carrying cost and the transaction cost over there. Similar model is here. So let's quickly look at this illustration here. Pure Air Company is a distributor of air filters to retail stores. It buys its filters from several manufacturers. Filters are ordered in lot sizes of 1,000 and each order costs 40 to place. Demand from retail stores is 20,000 per month. Carrying cost is 0.10 filter per month. Make sure that you guys either use monthly or annually. Compute the optimum order quantity with respect to so many lot sizes, guys. Can anyone tell me the answer for option number A here? Considering the formula we know, 2 into annual demand into cost per order upon annual holding cost. So now either you use annual or monthly, that's okay, because it will be like both multiplied by 12. So give me your answers quickly, guys. Don't forget that this is in the lots of 1,000. So whatever answer you are giving, divide by 1,000, right? Because they're saying with respect to so many lot sizes, how many lots? I'm seeing answers as 4,000 coming up, which looks to be good answer. But guys, do you intend to say 4 lots? 4,000 means 4 lots. All okay, guys? 4,000 would mean a 4 lot here. Yeah, great. So I think that's a perfect answer, guys. Then you have a couple of more questions with respect to that, which you can try later on for calculation. What if my carrying cost or ordering cost change? That you can try later on. Now let's do one thing, guys. It's almost like 7:18. Let's take a quick 10 minutes break here. On the other side of the break, we will just have a look at one important slide which talks about the working capital sources, how the working capital sources can be funded. We talk about the Tandon committee rules. And then after that, we are on to quick practice, guys. So we almost have like slight over 1 hour left. So after the break, we meet and we'll have like 5 questions over there. We'll try to cover almost 3 or 4, or at least minimum 3 questions. And then the 1 or 2 remaining questions could be your assignment. So let's have a 10 minutes break now and come back and wrap this up, guys. See you on the other side of the break. So welcome back, guys. I hope everyone is back from a good, refreshing break. So we are talking about some important aspects where we started from working capital. That okay, working capital could be uh, required at different levels based on the different seasonal requirements, depending on the nature of the business. And we also discussed one aspect that some working capital could be permanent and some could be temporary. Remember our graphs, couple of graphs we discussed. A permanent working capital always stays invested in the business, if even if there is a sale or no, because you would need some inventory. Of course, you can't have an empty showroom. Now that permanent working capital, now what we're looking at here is we are thinking from a perspective of, hey, we talk about the investing decisions. Now we also talk about how the same will be financed. So the permanent working capital would be financed generally by long-term sources of debt or equity. So that stays invested, right? However, the temporary working capital, which is like on and off, or the levels can be high or low, that is what is financed by the short-term sources of finance. Now there are different sources here. We talk about even one very interesting one today, that factoring of receivables. That is one we discussed today. We talk about the normal time allowed by the creditors or the bills payable or the utility bills, accrued expenses. All these are definitely supporting you in the working capital. Intercompany loans or deposits or your retained earnings. Very, very important, right? Funds generated by the operations itself. That's one piece. Commercial papers, bank overdrafts, guarantees, and so on. Now, from a financial institution's perspective, the recommendations from a maximum financing as done by the Tandon committee, of course, there are three different definitions which you can go through your subject guide or in terms of a study material, where we are looking at 25% of either the working capital or current assets, depending on the definition you guys are using for the current assets. So 25% is the maximum, which, or I would say differently, that not maximum, but we can say that 25% of the working capital should be funded by the long-term funds, and the balance could be your maximum permissible finance. Everyone okay, guys? So even the expert committees recognize that fact, that this is a maximum, or rather the working capital would be split into permanent or temporary. So permanent is something should be financed by the long term. That's what they also appreciate, right? So having said that, let's move ahead to a little bit of a practice here, guys. I think we have done a good practice the other day, but let's do a quick recap of what is the working capital requirements in one of the questions. And we will also talk about different analysis in terms of what we are looking at, the evaluation of the policies. I think the example we did today, and we'll also try to do a question on comparative cost of financing with respect to banking, trade credit, or factoring. So I have around the file you guys have. I think it has almost like 5 practice questions. We'll see how many we can quickly cover today. So let's try to do this question first, which is on the screen now, which is a PQ Limited, a company newly commencing the business in 2019, has the following projected P&L, giving sales, COGS, administrative expenses, profit before tax, and the COGS has been arrived as below. So COGS, how the 153 is comprised of, is basically the material used, wages, depreciation, and this is the cost of manufacturing basically. And how much is the stock of finished goods? 17,000. So that's my cost of goods sold, 153. And the cost of goods sold relate only to the finished goods, not to the work in progress. I think that kind of brings a little bit of a smile as yet, but don't smile too wide right now, because we might need to calculate that. Goods equal to 15% of the year's production will be in progress on the average requiring materials. That means you're talking about closing WIP. So that's the area where you need to be slightly careful. So goods equal to 15% of the year's production will be in process on average requiring full materials, but only 40% of the other expenses. So this could be also important line that in terms of the other expenses, we are looking at 40%. Materials will be 100%. Company believes in keeping materials at 2 months consumption, so raw materials. All expenses will be paid in 1 month in advance. Suppliers of materials will extend a 1.5 months credit. Sales will be 20% cash and rest at 2 months credit. 70% of the income tax will be paid in advance in quarterly installments. And 8,000 is to be done in cash, and 10% is my working capital, buffer. Okay, let's do this thing. I'm sure each and everyone is kind of excited here. Give me a quick second. So where do we start, guys? I want your inputs now. I want you guys to maybe lead the solution here. How do we go about this? I want everyone to take a snapshot of this slide, maybe. That would be good, where you guys have the question in front of you at all the times. And then we can have a starting point somehow. How do we go about with this question? I think in terms of the calculation of the current assets, let's target on inventory first. So within inventory, we have raw materials. So how much is the raw material, guys? From the question itself, they gave you the point that keeping materials equal to 2 months consumption in stock. Interesting. So what will be the raw materials here? Guys, I hope you guys can see the screen when I'm writing here. So what is the consumption for raw materials, guys? And your thoughts? Alok says 14,000. What about others? How did we calculate 14,000, guys? Okay, you are saying that 84,000 divided by 6. That's what everyone did, 14,000. I need to be very, very careful here. And I think that's where everyone is kind of getting a little bit of a tricked. And I'm sure once I tell you this, you guys might start scratching your heads a bit. We need to be little careful here, guys. Slightly little careful. What is the language we are using? We are saying company believes in keeping material equal to 2 months consumption in stock. My point is consumption 84,000? Guys, 84,000. Do you agree that we needed to also add 15% because that's WIP? 85,000 is only the part of the cost of manufacturing which is like given to us, but we also incorporate the WIP, guys. Mind you, they gave you the point that cost of goods sold is not relating to WIP. That is something you need to calculate. I underline that line later on. So 84,000 plus 15% into 2 by 12. So my total raw material consumed is 96,600. Na? I think most of you missed that. So raw material inventory 16,100, guys. So WIP is already giving you trouble. So you need to be careful, guys. When you see WIP, practice it. Great. Let's target WIP also now, right? Now, WIP, within WIP, if you have to calculate the, what is raw material, we just calculated 84,000 into 15%. 12,600. And labor plus overhead, guys. I think in the question they said 40% of the other expenses. So 62,500 plus 23,500. So we are talking about 86,000. Anything else? In fact, do you include depreciation? I don't think so, right? Only 62,500. So wages and manufacturing expenses. So only that. So 62,500 into 40%. Into 15%. Don't multiply only with 40%, but because also WIP is only 15%, right? So getting 2250 or what? What is the amount are we getting, guys? No, 3750. Okay. So we are looking at 16,350. Guys, can you please confirm if WIP is clear to all of you? Mind you, this is given in the question itself. Labor plus overhead, the other expenses was given to us in the question itself that 40% of the other expenses are incurred in WIP. Any questions so far? Okay, then we can go to your finished goods, right? I think finished goods should be most straightforward. I don't think there is any problem in the finished goods. Ignore depreciation, please. So 84,000 plus 62,500 is my total cost. Right? Now, how much is the finished goods, guys? 10%. That is given to us in the statement itself. So someone can argue with me that, sir, in the P&L, they have given the stock of finished goods as 17,000. Why can't we take that directly? Because that includes depreciation also. So it is 14,650. Or you could have excluded the 10% of depreciation from 17,000. Other way around. 17,000 minus depreciation 10% is 2350. Should be giving you the same answer. So what is my total inventory, guys? 16,100 plus 16,350 plus 14,650. I think my total inventory levels are coming to 47,100 now. Okay. We also need to calculate the debtors here. Now be careful for debtors, guys. Cost of sales. So debtors is, okay, sales is 20% of cash and rest is 2 months credit, right? So 80% credit sales. So what is my cost? How do we calculate this, guys? In terms of debtors? Cash cost of sales. Material is how much? 84,000. Labor and overhead. We have 60 to 500. What other expenses we need to add? I think admin and sales, selling and distribution expenses are also there. I think other expenses 27,000. 14 plus 13. We have 84,000 plus 60 to 500 plus 27,000. Anything else, guys? We need to add here. Just a thought. What do you think? We're getting a 138,800 here. Do you also have a closing stock? We're doing cost of sales. I think we calculated that for debtors. Oh, I think that was how much? Closing stock of finished goods, 14,650, right? Any problem, guys, in this calculation? Any problem in this calculation? I can see one problem. And I want your inputs on this. Please double check. I want you guys to identify if there is any issue. Okay, Geet says tax. Geet, what about tax? What should we do about the tax here? No one is identifying this. Guys, do you agree that when we are reducing the closing stock, we probably should not, okay? Guys, you need to be very careful. Is it okay to do this 80% and then reduce the closing stock? No. We are not calculating cash cost of sales then correctly. Are you getting me, guys? So basically what we need to do is, we need to use this amount 173,500. That is my total expenses minus 14,650, and you get 158,850. This is your total cash cost of sales. And then you can multiply this by 80%. Because mind you, even the closing stock could result in a cash sale and credit sale later on. So make sure. So we're getting a 127,080. And how much was that, guys? How many, what is the credit period? 2 months, right? 2 by 12. So I'm getting my debtors as a 21,180. Manoj says add opening. Someone says WIP also there. Okay. Geet has a very, very interesting question. That WIP is a Geet. Let me make a star here and we'll see what about WIP. The very, very good observation. Shouldn't we have included the cost here with WIP also? Geet, at this point, I can tell you that if you add WIP here, that's absolutely correct. But then you also reduce WIP at the bottom along with the closing stock. At the end of the day, you will get the same answer. But I definitely agree with what Geet said, that WIP include in the material labor the WIP amount and then reduce in the closing stock, it will nullify. Everyone okay, guys? So till now, let's do one thing. I think we are left with one aspect, that is prepaid expenses. So what are the prepaid expenses here? So prepaid expenses was given to us 1 month in advance, right? All expenses 1 month in advance. So what were my labor and overhead? I believe 60 to 500. Then we had administrative and selling and distribution, 27,000. It's like 89,500, 1 month in advance. I will get a 7,4. Can you please check the calculation? Okay, someone said it's not 62,500, it's 66. Okay, so this is interesting. I think that's interesting. So 62,500 is given to us, right? But is it 62,500? There is also a WIP element, right? So we'd rather add that as well. So 62,500 plus 3,750, I guess. So 66,250 plus 27,000. How much will be that, guys? 93,250, that means. So WIP element also is there. 93,250 divided by 12. How much is the amount now? Anyone? Abdul, WIP amount. WIP also to be included, na? So this is a very, it sounded a very, very small question, but it is actually a little tricky question with respect to the WIP involvement to be taken separately at each stage. Right. So let's talk about this now. How much was my inventory, guys? Okay, hold on. Guys, is there any other prepaid expense? I think yes, we had. Taxes also. There's a tax information also given to us. 7. So how much is the tax amount, guys? So tax was given to us is 10,000. 70% of the tax will be paid in installments, in quarterly installments. Great. So 70% into 10,000 into 1 by 4. 1750, I suppose. 9521 is what I am getting. Hence, if we calculate our gross working capital or current assets, so we have inventory calculated with us, which was how much? 47,100. We have accounts receivables, debtors, 21,180. We have prepaids. I think everyone calculated here 9521. And something cash and bank is given to us, right? In the question. Cash and bank was given in the question, I think 8,000. So how much is the total gross? We have to yet calculate the current liabilities also. I think we're getting 95 or what? No, 85, 801. Guys, everyone with me on this till this point? Alok, include cash also. 8,000 cash is also given in the question itself. Now I think we are not too far. We just need to calculate the current liabilities. Okay. So what is the calculation of current liability says? First, let's talk about accounts payable. They talk about all the suppliers of materials will extend 1.5 months credit, guys. So how much purchases do we need to include here? Can anyone tell me the purchases? What will be the purchases? How much is the raw material consumed here? 84,000 plus 15%, right? 96,600 is the raw material consumed. And there is also ending inventory, the closing stock. How much is that, guys? The closing stock is 16,100. So that means my total purchases would be this much. What do you think? So that into 1.5 by 12. Which is like 14,088, if I'm not wrong. Can you please double check? 14,088. Current liabilities, accounts payable. Any thoughts so far? Okay. Now, guys, one more important thing is be careful. Is there any outstanding expenses? I can see there is an outstanding expenses, that is your tax payable. Mind you, you only talk about 70% of the tax payable, right? Whereas the provision was 10,000. So my current liability is 17,088. So hence my current assets from the last slide are 85,801. My current liability is 17,088. We're looking at a 68,713 plus margin of safety is, I think 10% is required, 6,871. $75,584, guys, is what is answer you guys should be getting for the working capital requirement. So there is a buffer also 10%, margin of safety. How did you like the question, guys? Mind absorbing? I think the only part which is need to be taken care of at every stage is how the WIP needs to be clear. And Geet, I have parked your query. We will discuss that right now. I told you that, okay, we include the WIP earlier and we reduce in the stock, it will give you the same numbers. But I would definitely recommend that that is a better approach. Okay, so guys, let me show you something. I hope all are clear with different steps. Can I get a confirmation from everyone? Okay, so now guys, can you see this solution slide? And I will, as I said, I will upload this later on. Now, guys, look at this. What we did a little differently here, and intentionally I did that. If you see the debtors calculation, guys, I'm using for calculating the cash cost of sales, I'm including the material, labor, the WIP element here, and this is for you. And then I'm reducing the WIP as a closing stock along with the finished goods. So it evens out and should give you the same number, but you guys can definitely prefer this way of solving it. include whatever was consumed, whatever was expensed. And I think Geet, that's what you were wanting to say. So for the debtors calculation, the number and the final amount will be same because you are adding the material and the expenses first and then you're reducing in the WIP, right? So the net impact is nil. Like you can see 150 at 850 is what we calculated. 1,50,000, 850 is what we calculated on our calculations. Guys, make sure that when you are solving it in the exams, give your working notes, elaborate if you are kind of taking any assumption. For the first of all, assumption is not always preferable, but yeah, in case you want to give, you should be giving that. Make your working notes easily and expandable. Guys, all clear on this question? Okay, so next, let's move to next question, guys. Next question on practice is we have the company called Slow Payers. I'm very much worried right now because the name of the company is Slow Payers, right? So probably we are having a little bit trouble in the collection there. So the slow payers are regular customers of goods dealers and have approached the sellers for extension of credit facility for enabling them to purchase goods. Now, on an analysis of past performance and on basis of information supplied, following pattern of the schedule emerges in regard to slow payers. So at the end of the 30 days, they're paying 15%, 60 days, 34%. And in fact, there is a 1% non-recovery also. Now, slow payers want to enter into a firm commitment for purchase. Now, firm commitment is like you will be doing the minimum transaction of purchase of 15 lakhs in 2007. Equal quantities on first day of each quarter. That means like 3.75, I suppose. Right? Price per unit of commodities 150, on which profit of 5 is expected to be made. Wow. It is anticipated that by good dealers that taking up this contract would mean extra recurring expenditure of 5,000 per annum. If the opportunity cost of the funds in the hands of the good dealer is 24% per annum, would you, as a finance manager, recommend the grant of credit to the slow payers, guys? So that is what the question is. How do we start this here? We're looking at a firm commitment, right, versus the extra cost. So how do we go about this? Okay, let us start with this, right? How much is my firm commitment? 15 lakhs, right? And out of this, the profit is we're talking about, okay, and how much the per unit price is? 150, right? So 15 lakhs divided by 150, we are looking at a 10,000 per unit, right? Sorry, 10,000 units. We're looking at 10,000 units, I suppose. This means we are looking at 10,000 units firm commitment. So how much is the profit on this, guys? How much is the profit on this contract? 50. The extra profit you are looking at from this 15 lakhs, 50,000. And what is the cost we are incurring, guys? I think 5,000 is the extra cost and 1% bad debt is already given to you. We're looking at 1% of the bad debts and there is a 5,000 extra cost. So 50,000 is my profit and 1% of 15 lakhs is how much? 15,000. So that means we are looking at a profit of 30,000. 50 minus 20. Is everyone with me on this till this stage? Net additional profit of 30,000 is what we are looking at. Now, the only point is what is the opportunity cost of the debtors here? That is what we need to understand. What is the opportunity cost of the debtors here? Of course, the only additional calculation this question entails is that we can't really just calculate the cost multiply by the return, because see, every like the part of the payment is done in like 30 days, 60 days, and so on. So you have to calculate the opportunity cost. Geet, absolutely correct, but the opportunity cost have to be calculated separately for 15% amount, for 34% amount, 30% amount, and 20% amount. That is for sure. So now I want to understand what is my total cost here. Can anyone tell me? What is my total cost? 14,50,000 is the cost, and then you are incurring extra 5,000, guys. The total cost becomes 14,55,000, guys. See, 14,50,000 is anyways the cost of the commodity. Price per unit is given to us 150, and profit is 5. So 145 into 10,000, 14,50,000 is my cost, and we are incurring 5,000 extra. So 14,55,000 is my cost. So 14,55,000 into 15% is 2,18,250. We are looking at 2,18,250. Let me write it at the top. $2,18,350. What about 34%, guys? $494,700. Then we're looking at 30% is 436. So what I'm writing here is these are the amounts you will be collecting in so many days, right? 30 days, 60 days, 90 days, and so on. And hence, our next calculation should be calculate the opportunity cost on these for 30 days, 60 days, 90 days, and respectively. And the cost is a huge amount. I can really say it's 24% is a huge amount, guys. I really doubt that you will be getting a lot of significant opportunity cost at 30,000 profit may not be looking so good. So let's see some numbers now. So we are calculating the opportunity cost here. You can see at the rate of 25% for so many days, my opportunity cost in total 4,305 plus 19,000 plus 25,000 plus 19,000. Looks huge, guys. Almost like 68,000 plus. Whereas we are looking at a profit of 30,000. I think this doesn't look to be a good perspective, good proposal for us to take care. As I said, the name is slow payers. I want everyone just to take a minute or two, digest it. Let me know if any questions. Anyone having any observations, any questions, any queries, please let me know. If it is clear, kindly confirm. Okay. I think so. Then we move to another question then. So let's see which question we do practice now. I have one more working capital question, guys. I request you guys to kindly do that as a homework. That is day limited. And then there is a cash value also. Okay, let us do this question, guys. This is the one on the screen now. Alliance Limited. So let's look at this question. Alliance Limited, a petrochemical sector company, just invested huge amount in its new expansion. So due to a capital investment, company is in the need of additional 1,50,000 in working capital immediately. Finance manager has determined following 3 feasible sources of working capital, guys. 3 feasible sources. 3 options to select. Bank loan. Company will lend 2 lakhs at 15%, or 10% compensating balance will be required, which otherwise would not be maintained by the company. This is a good point. You're not carrying any minimum balance. Compensating balance is minimum balance, guys. So that means, this means even if I'm taking 2 lakhs loan, how much I will be really using, guys? 1,80,000 will be for use. Do you agree? That's what it means. Second is trade credit. Company has been offered a credit terms from its major supplier 3/30 net 90, sorry, for purchasing raw materials worth 1 lakh per month. And third is factoring. Factoring will buy the company's receivables of 2 lakhs per month, which have a collection period of 60 days. And I think the factor will advance up to 75% of the face value at 12% on annual basis. There is also a commission of 2%. And I believe the rest would be the factoring reserve. It has been also estimated that factor services will be saving the company a credit department expense and bad debt. Okay, very good. So whatever we did today is like give her as a alternative already, that factor services, due to them, you will save the company a little bit of an expense and bad debt, which is 1,250 and 1,750 per month. So it's like 3,000 per month. Now, it's a very, very interesting question, because they are asking us advice, which alternative should the company select? My question would be to you guys, on what criteria you will say that which is the better option, guys? What criteria will help you to decide which alternative should the company select for working capital financing? That is what I want you to calculate, or at least tell me what criteria we will use. We will calculate that, but I want to hear from you guys. What is the criteria we are using? Okay, Geet says cost of borrowing from all options. What about others, guys? Okay, so let's do one thing. Let's go to the different slide and try to give some kind of a quick calculation on this one. Anyone else? How do we solve this? Like, what should be the criteria? I think what Geet says is that in terms of the Alliance Limited, if you're going from 3 options, select the option with the lowest cost. Least cost, lowest cost. That's fine. So let's calculate one by one, guys. Now, in that particular question, we are looking at bank loan. Mind you, there is a compensating balance, right? 10% you can't use it, 15%. So let's say if we talk about a 15% interest with 10% compensating balance. So my real interest is high, guys, because I'm not able to use the entire amount. So let's say if I say I am borrowing $100, I will be using only 90. So my interest here is, real cost of interest would be is like 15 upon 90, guys. Anyone tell me what is that? I think 16.67%. I hope everyone is clear that what is a compensating balance, guys? Are you not able to use the entire amount? Someone says that, sir, amount is given as 2 lakhs. We can use that, guys. That's okay. So if you're saying that, okay, 2 lakhs is given to us, that's fine. So 2 lakhs may say you are using only 180 now. but you are paying on 2 lakhs. So that is your 30,000. So my answer would be same, of course, 30,000 divided by 1,80,000. So I think it should be giving you 16.67%. Okay, let's go to the second option, guys. What is happening in second option? We're looking at a trade credit. You know the formula? We did discuss something today, guys. Cost of foregoing the discount. This is the company has been offered credit terms 3 by 30 net 90. So cost of foregoing the discount. What was that, guys? We are looking at what was the discount? 3%, right? We're looking at 360 upon 3 by 30 net 90, right? So we're looking at 90 minus 30 here into 3 upon 97. So 360 divided by 60 into 3 divided by 97. So we're getting at 18.56%. Guys, can you please double check if that's what you're getting? And if that is the case, if you guys all agree with the number, do you all agree that this option can be rejected? Already, without even looking at the third option, because this cost is higher than the earlier. Option 1 was 16.67. So 2 is higher, so that can be rejected. All okay, guys? Okay. So moving on to the third option. Now, third option is interesting because we discussed something today with respect to the factoring, right? So what are the factoring expenses we are talking about? Let's talk about one by one. I think we had a commission. How much is the commission we have? 2%, if I'm not wrong, on 2 lakhs. That's per month. 2% of 2 lakhs into 12. 48,000. Okay, Geet has an additional point. Geet said that in terms of the trade credit, it will increase the sale. Need to consider that factor. But Geet, my cross question to you would be, wouldn't that be the case for all the 3 scenarios? And since they have not given anything with respect, any information with respect to that, we can't say that, okay, to what extent the sale will be increased with option 1, with option 2, with option 3. Yeah, I could see that. I saw your second comment now. I hope you agree with me. That impact would be based on for all the 3 options, right? Right. So we can ignore that. But anyways, as always, good observation. Okay. So 48,000 is one. What is the other aspect? So we're looking at any other expense we are looking at? Interest, right? So how you are calculating interest? So 150,000, 75% is what we're looking at, right? So 2 lakhs is my receivables. they are willing to advance 75%, that is 1,50,000, and that's 12%. So now I can do it 1 by 12 and then multiply by 12. It's one of the same thing. So am I getting 18,000 here, if I'm not wrong? What I was saying, guys, is you can do 1 by 12 for making it monthly, but then you have to again do it 12, so it gets cancelled out. So I think we're getting 18,000. And I think you have savings also. So don't forget that. Yes, Alok, that's what we discussed. Okay, what are the savings, guys, given to us? 1250 and 1750 savings also. Now be careful, monthly. So that is 1250 plus 1750 into 12. 36,000. So my net cost is 30,000 here. And how much is my receivables, guys? 150. So 30,000 divided by 150 is looking to be 20% cost of factoring. Manoj, that's okay. We can't challenge the question. Manoj is having a very valid point. What about the factoring reserve? They're not given anything about that, right? Okay. First of all, do you really need a reserve in this case? You are anyways giving an advance on 75%. So, Manoj, do you agree that you don't need a reserve now? You're anyways giving only advance of 75%. So 25% you are not even giving the money. So that you can treat as a reserve. Manoj, makes sense? The factor is advancing only 75%, my friend. That 25% is what? Is what they are retaining. It's just that we are not calling that as a factoring reserve, but that it is what they are not paying us. Everyone okay, guys? Okay, now that means, can we safely say that even this option should be rejected? So I think the cheapest option we are looking at is the 16.67%, option number 1. Bank loan. Jaspreet, what do you think? Geet. Okay, Geet says something. Give me a second. Okay. Anything, any questions, guys, from anyone else right now? Okay, let's go back. This is what we have here, and you guys can check your calculations in a while. Just giving everyone 1 minute to absorb. Okay, guys, so now I have 2 more questions which I would like you to take up as a home assignment, and I will upload the answers also on the same. So let me just walk you through the couple of questions we have. Give me a second. Okay, this question is of a day limited. Now, if you see the question quickly, that giving you a lot of information with respect, working capital requirements. They're talking about the completed units of production plus work in progress. I want you guys to practice this, guys, either today or tomorrow. Please practice this question because we're talking about a work in progress here, 31,200 and work in progress. Material, wages, overhead, everything. But in the overhead, make sure that you take care of this, inclusive of the depreciation that you might need to exclude. Selling price is 130. So average 30 days consumption, work in progress, given to you, material 100%. Mind you, we discussed WIP, the very first question we did, remember, on Sunday, that labor and overhead were incurred evenly throughout the year, evenly or accrued evenly throughout the month, where we did half of this. Guys, do you remember that question? And in all the questions we are doing today, they're already giving you conversion cost as 50%. So doesn't it mean the same thing? So guys, can you see that logic applied in other questions also? Finished goods stock is given to you, credit allowed by suppliers, allowed to purchasers, direct wages lag, cash balance, and look at this. At the end, they have given that line also here. Wages and overheads accrue similarly. When we are saying similarly, because production is evenly throughout the year, so then the wages and the overheads are also accruing throughout the year. So yeah, so Abdul, you don't need to divide by 2, right? You're just multiplying that by 50%. That's one and the same thing. So please do this question, and let me just show you another one. Please practice this question, and there is one more question I'm giving you guys as assignment here. This is preparation of, I believe, cash budget, right? So yeah, we are looking at information that is given to us from cash balance on 1st January. So we are looking at a cash budget, and they're talking about this. This is another example we did on Tuesday, wherein we were looking at like 50% of the total sales are cash sales, and they were giving like, when are the credit sales collected, and also they're giving you, look, okay, the assets have to be acquired in Feb and April, provisions are made for the same, application has been made to the bank for the grant of loan of 30,000. It is hoped that the loan will be received in the month of May. So they're giving you specific aspects, right? So when are you planning to acquire the assets? Feb and April. Then they're talking about the expectation of the loan in the month of May. So those specific months will have these payments and receipts, right? And also the dividends of 35,000 will be paid in June. Now look at this. Debtors are allowed 1 month's credit. And credit is for material purchase, and overheads are given 1 month's credit. So that means we need to understand that, okay, whatever the debtors are, it is 50% of the sales. That is 50% of the credit sales. So if I have to prepare a cash budget here, we need to understand they're giving you a 72,000 sales here, right? They're giving you a 72,000 sales. How much amount of that will be a credit sales, guys? 36,000 that will be collected in Feb. 36,000 will be cash sales, right? Similarly for Feb, March, and so on, right? And similarly, then they're talking about the creditors. They're giving us the material purchases, which is given one, kind of like January purchases will be paid in Feb purchases will be paid in March. So everything in a 1 month lag. Everything will be on the 1 month lag. And then you are providing for the material, the assets purchased in the month of Feb and April, and then the loan is kind of expected to be obtained in the month of May, and then they're giving you the information with respect to the dividends also. So the month specific information needs to be accounted for. This should be a very, very straightforward question. Otherwise, you need to be just careful about what all you are doing. Otherwise, this is a very, very straightforward question. Okay. So I hope you guys will do these two homework assignments. And I think with that, we can wrap it up today's session well in time. And I thank you all. I think it was a wonderful journey with all of you. I enjoyed kind of taking you through to some important aspects with respect to I think we started this journey together with cost of capital, and we talk about investment decisions, and now 3 back-to-back sessions on working capital management. You guys are amazing chunk of students who have been doing some hard work, real hard work, and you guys really mean it. And I request you guys to carry on this kind of an attitude. And, I'm sure your hard work, discipline, your dedication, perseverance will all definitely lead you to that light at the end of the tunnel. Just kind of make sure that you guys carry on this attitude even after once you are chartered accountants. Always be, humble and honest. That would be my piece of advice, and wishing you all a very, very best of luck for your upcoming examinations, and all all of you and your family members are very happy Holi in advance. So be safe and do the good work. I'm sure you guys will come up with flying colors. But remember, only 3 shortcuts to success, which I've been telling you always. It's like practice, practice, and practice. So there is no other word which can take you there. So keep on doing that. Keep on studying. Make sure that you guys follow your schedule. And of course, apart from that, we guys can connect on LinkedIn and other networks. I'm sure we will be in touch in one way or the other. So all the best, guys. Have a good evening and best wishes always. Take care. Cheers. Bye-bye.